How's it going, traders? Welcome back to the channel. In today's video, I'm going to show you exactly how I count my levels from the daily time frame all the way down to the M15 and how that helps me identify the market maker cycle. I'll also be showing you two powerful entry approaches that I personally use. First method we're going to talk about is the anticipation method. This is when you predict the peak before it's fully formed. As you can see, what we have on this example is we've got a peak formation, one level of drop, a second level of drop, and what we can do is anticipate the last push being the third level of drop, giving us a peak formation, allowing us to enter the market as the market reverses. The second method we're going to talk about is the conservative method. This is when you wait for the peak to be set and then trade the confirmation move. Now, as you can see in this example that I have, we have a confirmed peak formation, and our next anticipation is a pullback leading us into level 2 after the peak formation has been confirmed. Alright guys, before we go any further, the market maker method is built on levels and cycles. The market maker operates in 3 levels of rise and 3 levels of drop. So before you can even count those levels, you need to know where the current peak formation high or peak formation low is forming, and that starts from the higher time frame. Always start from the daily time frame to identify structure and direction. Here's what I'm looking for: clear swing highs and swing lows, previous reversal zones or accumulation distribution areas, the general direction of the market maker cycle. Are we in a rising phase or a dropping phase? Think of the daily time frame as your big picture compass. It gives you context of where the 3-level structure is likely to be forming. Once I spot that, I mark out the last peak or bottom and label that as level 1 or start of the cycle. Let me show you some examples on the chart. Right, guys, so we're looking at GBP USD, which is the pound US dollar, from the daily time frame. And I'm going to be showing you how easy it is to count your levels with clarity from these higher time frames. So what we can identify in the daily time frame currently is we had price moving away from this supply level. As you can see, when price was moving down, we identified a drop being a level of drop, a pullback giving us another level of drop, long sustained run giving us a pullback, and the last level of drop. But as price was dropping, as you can see, there were areas of liquidity being left, right? So we had these liquidity pools around about these areas right here, right? But we're not going to focus on that right now. We want to focus on more on the recent side of things, rather. All right, so as you can see, when price pushed into the supply zone, that is when we had our peak formation. All right, that is when we had our peak formation. As if we can zoom out, this was a multi-day or multi-month rather, as this is our daily time frame M formation, which is one of our peak formations that we look for. All right, so this is what we can clearly identify from the daily time frame. We had the peak formation, a long sustained run. In this case, these were 3 days of drop, but within our daily time frame, this is seen as one level of drop. From that one level of drop, what we identified is another level of drop, right? In this case, being 2 days of drop, giving us another phase of consolidation, or a pullback rather, back to this supply area. And from this pullback or consolidation, we can see the market now giving us another move going to the downside. All right, so looking at things from the daily time frame will always make it very easy for you to simplify your level counting and identify it with clarity, because as we all know, level counting is one of the most difficult things that people have to learn, right? It's not easy, right, for those people who have been following the market maker method. So it is always advisable for you to count your levels from the daily time frame. All right, now side note, one level in the daily time frame is seen as 3H4 levels. I'm going to repeat that. One level in the daily time frame is seen as 3H4 levels. Right, so this is where we refine it now. Moving down to the H4 time frame, if we can zoom out, this is what we have. So as you can see from this area that we identified in the daily time frame, that is when the market reacted to a supply area, giving us that peak formation. Now, this is what I want you to see. This area, let me just change the color so that it can be easier for you guys to understand how you can count your levels better. So I'm going to change this 1 day of drop to the color blue. All right. I'll change it to blue, and then we will look at it from the H4 time frame to see how you can then work with these time frames to get a directional bias as you count your levels. So this is what we have. This is one level in the daily time frame, but when we look at it from the H4 time frame, what we can actually identify is, let me just change the color, but I want you to keep the fact that at the back of your mind that one daily level is actually seen as 3H4 levels. So from the peak formation right here, this is what we can see. From that, stop hunt up there, we had the move down being one push into a consolidation. We can identify a pullback, another push down, right, an area of consolidation, and we identified another level of drop. So as you can see, basically what we have right here is 1 week of drop, right? That's what we have. We've got 1 week of drop. As you can see, the week began right here and ended here, and this is what we could identify, right? False move week beginning, right? A stop hunt, trapping traders, and then moving the other direction as our midweek reversal was presented. So from that area, we can identify level 1, level 2, and level 3 into a consolidation, giving us one daily level. So that is just one level in the daily time frame, right? So this will make it easy for you to anticipate your trades, right? So now we're going to take it down to the H1 time frame uh, to see how you can actually anticipate peaks, or if you miss them, how you can actually anticipate trades that can actually help you jump on the move, even though it can be a bit too late, but this is more conservative and you have got less risk on the table. All right, in this example, we are looking at gold from the H4 time frame, and from the two types of entry types that we spoke about, the first one would be the aggressive approach, which is anticipating the peak formation. In this case, that would be you anticipating the second leg to be formed. Right, now if one misses that, what we can do is, once the peak formation has been formed and confirmed, we expect a pullback leading us into level 2 after the 1350 crossover. Now, this being the H4 time frame, you might not see it here, but as we go down to the M15 time frame, it will be easier for you to identify and actually see these moves happening. So this was actually an anticipation that I had on gold last week, which I did send to my VIP students. And in this case, what I wanted to see was a pullback, and I wanted to see a peak formation form at this 50 EMA. So this light blue EMA right here is a 50 exponential moving average for those who might not know, right? So what I wanted to see was a peak formation being set here and a push, preferably down to this demand area, or an interaction with that 200 EMA. Now, if we take it down to the charts, this is what we can see. That is exactly what happened, right? We had a peak formation being set, right? Giving us a first leg and a second leg, giving us an information, and we had a push to the downside. Right now, so we're going to take it to the M15 time frame and show you how you can actually enter these trades from the peak if you miss the peak, and how you can actually jump on from a more conservative entry point. So with this gold setup here, I also sent this out to my VIP students. As you can see, this is what we had. This was around 1 a.m. my time when I sent this out, and this is what we had. As we all know, gold has been, making or giving us peaks, and a directional bias is getting set usually during around Asian session, right? Which is a bit rare. But remember, with the market makers, right, they don't really have a specific trading session where they'll give us, these peak formations, right? There's always variations to the theme, so they'll always change it around. So that is exactly what I identified. We had a drop, base, drop. As you can see, very good imbalance from that area, this being our supply area. So I wanted to see this go all the way down to this area at about 3923. Right. So as you can see, that is exactly what happened. Price then pushed all the way down until that target was reached. So right now we're going to take it to the M15 time frame to show you exactly how I time my entries and how you can do the same by understanding the market maker cycle, the level counts, and how you can minimize your risk as you trade. Now, if you'd like to take this a step further and actually trade with me daily, I've opened up something special for the people who watch my videos all the way through. I'm giving the first 10 people from this video access to my private live trading sessions where we trade gold, NAS 100, and currencies together every day. You'll get access for a full 12 months for only $150. After that, the price goes back up. So if you've been serious about mastering this approach, this is your shot to learn directly with me live every day. Right, so as we anticipate the high or low of the day, if you're not experienced enough to be able to catch these points, what you can do is very simple. Once you have identified, this is obviously after counting your levels and knowing the directional bias of the market. Once you've identified the high of the day or low of the day, what you wait for after a 1350 crossover, which is the crossover of the 50 EMA and the 13 EMA, which confirms the lock of the peak. Once that has happened, what you wait for is a pullback to the 50 EMA. So as you can see, if you had missed this whole move, instead of trying to jump in the market when the market had already left and usually finding yourself in losses, right, because of not being sure, or finding yourself over risking and closing out your trades early because, of not really being sure if the market will continue in that direction. Only thing that you wait for is a pullback to the 50 EMA. Another factor of confluence you can look out for is structure, right? In this case, we've got hidden base where we've got a base drop. So this is a supply zone, right? And as you can see, as the market pushed down, we had another pullback to the 50 EMA, a nice trap move up above the 50 EMA, as you can see, and the market continued moving down. Even today, right, as I'm recording this video, you can see we had a pullback just above the 50 EMA, and the market is moving down, right? So we can look at this and identify these structures across all pairs, right? Remember, there's no need for one to be stuck to one pair if it is not clear. But looking at something like this, right, when the peak was set in this case, which is the high of the day, and you missed out on it, we clearly identified a 1350 crossover. After the 1350 crossover, we had the pullback to the 50 EMA. Now, I'm not sure if you are going to be able to take these trades, this trade right here. Right, you really need to be very selective when it comes to trading such, because you can see this happened at the session crossover. As you can see, the day it ended. So usually your spreads are a bit too much right here. So you need to be very, careful when you are trading such setups. But this is something that is expected, especially trading something like Euro AUD. Right, so this can be identified across the board. As you can see, on this day, we had the peak being set, right, being our low of the day, and move up. First pull back to the 50 EMA wasn't really that clear. And as you can see, the next day, we had the peak being set right here, just below the 50 EMA with the W formation, and we had a move to the upside. Right, so this is very important, right? All you need to do is you need to be able to anticipate and identify your high or low of the day as you understand your level counts, your market structure, and this will make it easier for you to actually jump into the market with less risk. All right, guys, I hope you learned something from this video. Don't forget to hit that subscribe button. Do check out our free Telegram channel for free signals and free setups. Find the links in the description below.